Alright, hello everybody. We got a post-market report. We're going to go over some headlines first and then broadly touch upon what the markets did. Okay, so first of all, let's get to it. March 1st, there was a Fed's notes, and let's see. They talked about predicting recession probabilities using the slope of the yield curve, and I think from what they said was that like the if the short-term rates were higher than the long-term rates, that would indicate that we were going to have a recession, but that there's some new circumstances and that the flattening yield curve um, is because of something, and I'm not really sure. It's just a bunch of jargon. But there is some good stuff to read about this, and you can go through it yourself. Go ahead, check out the Federal Reserve page. What I'll do is I'll put the links in the description below. Okay, so the conclusion says here. Um, okay, in this Fed's note, we show that a um, univariate probit recession relating the probability of a recession at some point over the next year to the slope of the yield curve predicts that the near-term recession probability has risen over recent years, despite the slight increase in the slope of the yield curve since the start of 2018. Okay, excess bond premium expenditure, the probability is much lower. So with whatever so if they extend the model to incorporate additional information from the yield curve or add the excess bond premium as an additional ex- explanatory variable, the predicted near-term recession is much lower. Okay, so there's also a lower predicted recession probability from a model that adjusts the slope of the yield curve to account for term premiums, basically what they just said. Survey of professional economists similarly indicate a lower near-term recession probability. However, surveys also suggest that the part of the explanation for recent flattening of the yield curve is that expected GDP growth rate in the long run has declined. So that's pretty significant because Trump has boasted about the GDP sucking, um, the economy not doing anything, and you know, oh, Bummer didn't really do much. What I think the average was 2.5 in his. So what? We're gonna get the same thing, 2.5, if that, but we're saying it's gonna decline. So what does that tell you about U.S. strength? I mean, of course, this is U.S. is much more strength, has much more strength than Europe. But still, it's not looking good. And the fact of the matter is, there's a change happening. So the change has been expected slower growth in the long run. Okay, James Rickards posted an article here. China's coming meltdown will rapidly spread to the U.S. Okay. Um. Okay. Let's see if we could. All right. Let me give you an example. A single cash advance of 100 million passed from corporation dressing to prop up 1 or 2 billion of bad debts. Okay, the most dangerous type of debt involves a daisy chain of insolvent corporations buying debt from each other. Okay, so it's a chain of debts, so they buy 100 million and it's passed on to the next corporation. Um, okay, so it's accepted in China. Um, will not the Ponzi scheme will not last much longer. Even Chinese regulators are starting to blow the whistle on bad loans, and the banks cover them up. So the good news is that China is starting to address the problem. The bad news is that if China gets serious about cleaning up this bad debts, their growth will slow significantly, and so will the world economy. Boom! There we go. We're slowing down. China's gonna have to slow down because it's not gonna be rapidly expanding its credit. Um, and we've made that note on the previous video that China's GDP was, I think, down. I think it was, India surpassed it for GDP. But China is the main producer of the world. So they pretty much are the yellow silk road. They're the key to business. Follow the money. It's China. Okay. There's no good way out. Um, China's already flip-flopped and it's easing up on financial reform. That works in the short run, but just makes the credit bubble worse in the long run. Oh, okay, yeah, exactly. Easing up on financial reform. So what they're doing is they're combination of debt cleanup and maxi devaluation of their currency to export the resulting deflation to the rest of the world. Um, Trump's new trade war with China, the effects will not be confined to China. Uh, so the trade war affected us in 2015, um, and we got more volatility and drawdowns in the U.S. Okay, switching gears here. The housing, one of the debts that get accumulated is the housing bubbles. So, like Canada's housing bubble is insane. We could do a video just on that. And when we had our '08, I'm pretty sure their prices just kept rising, whereas our prices tanked because I don't know why. We'll have to look at that as well. That'll be a topic of another video. But this is just a video news real quick of um, events that are coming down and that are kind of telling us what's going on in the markets and in banks. Okay, so he basically says, goes through the details here, but this is the note that there are several headwinds for housing this year, including higher mortgage rates, higher um, impact of tax regulation, higher labor costs, higher material costs. Lumber prices are up sharply, which are tariffed, and they come in from Canada. And I'm pretty sure like that's 30% of, it's a big chunk of home buying, of home building, and overall affordability. So he says, I think housing will be okay this year, but I'm watching for any slowing. And that's really the key. Pretty much more and more people are not going to be able to buy houses. So when this starts to come into the data and starts to show, then, it's going to be too late and everyone's going to be rushing for the door out. Okay. Mortgage rates hit more than 4-year high as investors brace for a more hawkish Fed. Okay. As we see here, 30-year fixed mortgage rate is increasing. We're now spiking 4.4%. Powell accelerated the sell-off. Powell was hawkish than more analysts expected. That's why there was the big 3-day decline last week. Housing demand is hanging tough. Data from Mortgage Bankers Association shows that applications for mortgages to purchase a home is more than 6.4% higher for the first 8 weeks of 2018 compared with the same period a year ago. Wait, let me read that again. Mortgage Bankers Association showed the applications are 6.7% higher. So that doesn't mean they actually got the mortgage. The applications are higher. And the applications to refinance are hung in. So they're higher than last year. Except for the second half of February. So that's pretty big. That's something to note. That's showing a slowdown, and we have to watch that trend. See what March does. Higher mortgage rates always take a toll on the market. Freddie noted in February, Americans take out fewer mortgages, home sales sink, builders break grounds on fewer homes. There's less building, there's less people to build the homes, there's less painters, there's less carpenters, there's less plumbers, there's less electricians. All of these people are going to be struggling for work. And, it's really like housing in construction is a humongous part of a growing economy. When we have a growing economy, it needs more construction. So, but you can't just build stuff. You can't just be China building ghost cities and not having the economic growth to back up those cities. You know what I'm saying? You need the you need the fundamental economic growth that we aren't getting um, in order to have a good, successful economy. So we're starting to see um, home sales sink and builders break ground on fewer homes. Okay, so what do we need to know about steel tariffs? Okay, so there's going to be a 25% tariff on steel and a 10% on tariff on aluminum. Um, to bid in a bid to boost domestic production and new jobs. Well, I guess that's the plan, but these tariffs can be, you know, these companies aren't going to build new factories just based on this tariff. It would take a lot more. It would have to be a concrete tariff that never changed. You know, we would have to open up new mines, or we'd have to get humongous good deals for ore. Um, Home builders immediately slammed the plan. Um, could have not come in a worse time. Um, Tariffs hurt consumers and harm housing affordability. Not only will this hurt housing, but this will hurt autos. The more it's not the fact. All right, so supposedly it's only going to be like a $750 increase on a car, but then if they sell, you know, a million cars a year, that adds up. That adds up. What's that? 750 million? Where's my calculator? Yeah, 750 million. So they're spending an extra 750 million, whereas their profits might not allow for that. So that's bad. That's bad. That's $700 million down the drain that they could have spent. That wiped out the tax cuts. So not wiped out, but put a dent in them, and then they can't buy back more stock. All right. This video is getting a little lengthy here. I want to keep these. My first video I made was pretty lengthy, about 20 something minutes. Um, I think I should keep the videos around 10 minutes. That way it's not a burden to you guys, and I can keep pumping them out, and that way it keeps rolling. Okay. New apartment buildings and condos will be hit hardest. Unlike single-family homes, require significantly more steel and aluminum in their construction than they do lumber. You'll see more price pressure in the multi-family space. That's pretty wild, because that's where most people who can't afford homes go. They go to these apartment building type setups. The supply situation isn't as quite as dire. Oh, wait. The concern is that more supply at the right price point and adding to the construction cost will only make it harder to build an affordable price point, which is totally agreeable. Like we said, here we go. Lumber tariffs from Canada had a bigger impact, so now it's double. They added 6 to 10,000 to the cost of a medium-priced home. Estimated the cost of an average multifamily increased just by 748. So that's not much. That's not much. Okay. But the cost of new homes isn't the only way tariffs has affected one-family housing. The Canadian lumber duty was also projected to reduce investment in single-family structures by 1.1 billion. If a similar reduction were to now occur because of these new tariffs, that would slow new home building. Inventory constraints could be further exacerbated and fuel even more competition for homes. Interesting. So that's a interesting comparison of what happened with lumber and what could happen with steel. So let's get this straight. There's a limited supply of homes, but there's some headwind for home buyers. Is that gonna make it? Okay, okay. If something, if the crisis occurs, no one is gonna be able to afford new housing. No one, no one. And by that point, like we previously stated, it's gonna increase the apartment building. Okay, so Lighthizer is changing gears here. Not really. This is talking trade on NAFTA. But Lighthizer is, I think, the U.S. Trade guy. Let's look him up because I forget. American Attorney General, a government official, is the current United States Trade Representative. Okay, sweet. Um, okay, Canada dollar dropped. Weakest level since 2017. Okay, and the most important here, the countries didn't make the progress that many had hoped for on the current NAFTA round. Adding to the complete NAFTA 2.0 will need an agreement of roughly 30 chapters. So far, only 6 have been closed. And basically, I fear the longer we proceed, the more political headwinds we will feel. So that means there's going to be, it's going to take more. The longer it goes, there's going to be more problems. And the U.S. wants it their way, and it's going to be tough negotiation. Okay, so it's 1640. Let's just talk about some things in the market here. What happened? Okay, let's look at a daily chart, and we'll get some analysis going. Okay, so Dow Jones still has this negative pressure here, but it seems like everything wants to rebound on the daily. Um, I think it's going to rebound on the daily. But how much is the question? I think this line is going to have to swoop more. It's going to have to do one of these guys or this. You know, we're not going to just turn down or up from here. So that's why I said this morning we're going to have stability, because I feel as though these markets are going to just stay in this range that we're in. But we had a big day today, as well as Friday. Is today Monday? Yeah, today's Monday. So big day Friday, big day today. Pretty much same thing all across the board. Dow is down a little bit, but supposedly that's because of McDonald's. Now let's look at an hour chart, because that's going to tell us a different. Okay, this shows that we're probably gonna open up higher and pop above it, but then fail it. Look, see, pop above, fail it, pop above, fail it. That's what it honestly looks like. Everything's up high, and we got to come down, but on the daily it's good. So what does that tell us? That tells us that, well, I don't know if we could really listen to the daily. There's not enough noise, technical information going on. Anything to do with gold? Gold does not look good. Gold does not look good. No. Anything else? All right. So what's gonna happen? I think again we're gonna pop up. We're gonna open a little bit higher, not too much, but a little bit. Gonna continue the curve. You know, continue the curve. We're gonna go up a little bit more, in my opinion. There's still more on the histo, and then at that point we're gonna test. We're gonna have to go ahead and test 2,700 on the S&P. We're going to have to test 7,200 on the comp, and we're going to have to test 2,400 if we happen to get a downturn. So my prediction is that we were going to be stable in these price ranges. So give or take, everything's calm, no bad news is going on, and that's that. I think we're gonna open a higher. You know what? Instead of me just saying I think, let's let's just type in. I only know the futures for NASDAQ. Okay, slightly higher. Okay. Unfortunately, I couldn't get you a 10-minute video, and it was 20 minutes. I'll try and wrap this up maybe quicker. I barely did any market talk today at the end. Looks like VIX is breaking out. Looks like we found bottom here at this critical 38%. Looks like this is curling. Okay, some things to watch for. Watch this crap going on right here. Watch, let's go. I want you guys to watch this. Oh, wait. Breaking news. Not that breaking. Okay. The Senate is expected to approve this week's most significant reversal of requirements since the financial crisis, including a significant retrenchment of the heightened security for banks with less than $250 billion in assets that was implemented of Dodd-Frank. It raises the threshold to $250 billion in assets from the current $50 billion for when some of the largest banks face stricter oversight, including the designation as systematically important. More discretion in when to require stress tests between 100 and in '08, the beginning of financial crisis, 65 global banks had assets more than 250 billion. 6 banks received 154 billion in bailouts during the crisis. Okay, so what this would do is reduce oversight for institutions that were deemed too big to fail in '09. I still don't understand. it's okay. We're just gonna have to end it here. You guys can go ahead and have fun with this information. Um, look for what I told you to look for, and I'll see you guys tomorrow morning, 8:30. Thank you very much. Take care, guys.